Strategic choices. Part A. Assess the suitability, feasibility and acceptability of different strategic options to an organisation. It is important that we give consideration to the criteria that management may use to select the strategies that they identify for the organisation. Strategies can be evaluated according to their suitability to the organisation's strategic situation, their acceptability to key stakeholder groups, and their feasibility in terms of resources and competencies. Suitability relates to the strategic logic of the strategy. The strategy should fit the organisation's current strategic position and should satisfy a range of requirements. Exploit strengths, that is, unique resources and core competencies. Rectify an organisation's weaknesses or deal with problems identified in it. Neutralise or deflect environmental threats. Help the firm to seize opportunities. Satisfy the goals of the organisation. Generate or maintain competitive advantage. Involve an acceptable level of risk. Suit the politics and corporate culture. The acceptability of a strategy depends on expected performance outcomes and the extent to which these are acceptable to stakeholders. Typical stakeholder interests may include: shareholders will generally be interested in generating a good financial return while keeping risk to an acceptable level. Management and staff may object to changes if they believe that a new strategy will not suit their skill set, or if they will be personally worse off. Customers may be unhappy with changes that involve higher prices or poorer services. Banks will want to see good future cash flows to repay debt. Government might block certain strategies, such as an acquisition not being allowed because it reduces competition. The media and public may protest if they believe a strategy will be detrimental, such as opening an out-of-town superstore which will damage small shops. Feasibility examines whether the strategy can be implemented and, in particular, if the organisation has adequate strategic capability. Feasibility can be considered against the organisation's financial resources, management skills, skilled staff, required competencies. If the organisation does not possess these, it may be possible to acquire them, but this is likely to require time and money. Part B. Assess the opportunities and potential problems of pursuing different organisation strategies of product or market diversification from a national, multinational and global perspective. For organisations who are looking to grow their business or to reduce the risk, diversification can be an option for them. Diversification can take the form of related or unrelated diversification. Related diversification is a strategy development beyond current products and markets, but within the capabilities or value network of the organisation. Related diversification can be achieved through either horizontal or vertical integration. Horizontal integration makes use of current capabilities by development into activities that are competitive with or directly complementary to an organisation's present activities. An example would be a TV company that moved into film production. Vertical integration occurs when an organisation expands backwards or forwards within its existing value network and thus becomes its own supplier or distributor. Backward integration would occur if a milk processing business acquired its own dairy farms, rather than buying raw milk from independent farmers. Forward integration will be if a cloth manufacturer began to produce shirts, instead of selling all of its cloth to other shirt manufacturers. Unrelated diversification is the development of products or services beyond the current capabilities or value network. Unrelated diversification produces the type of organisation known as a conglomerate. Conglomerate diversification involves the development of a portfolio of businesses with no similarities between them. Part C. Advise on how the 7 Ps, including price-based strategies, differentiation and lock-in, can help an organisation sustain its competitive advantage. Creating a sustainable competitive advantage requires organisations to make important decisions about the strategic options available to them. The strategic choices an organisation makes regarding its marketing strategy will be driven by its choice of generic strategy. Creating a marketing strategy involves developing and tailoring elements of the so-called marketing mix. Marketing mix is the set of controllable variables and their levels that the organisation uses to influence the target market. The marketing mix consists of 7 Ps. 1. Product. The item or good purchased by the customer. From a customer's point of view, this will be a solution to a problem or package of benefits. 2. Place. How the product is delivered to customers, for example, sold in shops or online. 3. Promotion. The activities involved in telling the customer or potential customer or customers about the product, for example, advertising, sales promotions, public relations. 4. Price. Setting an appropriate price with reference to factors such as cost, competitors' prices, perceived quality, firm strategy, etc. 5. People. The interaction between customers and the organisation's staff. 6. Processes. Fast and efficient processes, for example, booking a service, may bring significant marketing advantages. And 7. Physical evidence. As services are intangible, it is sometimes important to provide evidence of ownership, for example, a ticket to travel or certificate of attainment for training. The final 3 elements listed above, people, processes, physical evidence, are also known as the service marketing mix, as they related specifically to the marketing of services rather than physical products. The intangible nature of services makes these extra 3 Ps particularly important. Part D. Apply the Boston Consulting Group, BCG, and Public Sector Matrix portfolio models to assist organisations in managing their organisational portfolios. Matrix-based models such as the BCG matrix and the Public Sector Portfolio matrix can be used by organisations to manage their activities. They can also be used by an organisation's management as a tool in making decisions about the future direction of the organisation. The BCG matrix, devised by Henderson, categorises companies in terms of market growth rate and relative market share. It assesses companies based on financial performance only. Assessing the rate of market growth as high or low depends on the conditions in the market. High market growth rate can indicate good opportunities for profitable operations. However, intense competition in a high growth market can erode profit, while a slowly growing market with high barriers to entry can be very profitable. Relative market share is assessed as a ratio. It is market share compared with the market share of the largest competitor. Thus, a relative market share greater than unity indicates that the company is the market leader. Henderson settled on market share as a way of estimating costs and thus profit potential, because both costs and market share are connected with production experience. As experience in satisfying particular market demand for value increases, market share can be expected to increase also, and costs to fall. According to their position on the matrix, companies will be categorized as follows. Stars offer good future returns, so the parent needs to invest in and develop them. Due to the industry life cycle, stars will become cash cows in time. Cash cows do not need much investment, so will generate cash income. Parents can use this cash to invest in stars or simply provide a return to shareholders. Question marks should be assessed to see whether they have the potential to become stars. If so, the parent should invest in them. If not, they should be sold or run down. Dogs can tie up funds and provide a poor return. In general, they should be sold off, although may be retained if they are a useful niche business. Ideally, the portfolio should be balanced, with cash cows providing finance for stars and question marks and a minimum of dogs. The public sector portfolio matrix classifies activities in terms of their popularity and the resources available for them. The matrix provides for an analysis of services provided by public sector bodies, which can prove useful particularly when making strategic decisions about public sector activities. This might be applied at the level of local or national government, or an executive agency with a portfolio of services. The axes for this analysis are service efficiency and public attractiveness. In this analysis, classified public sector organisations can be classified as follows. A public sector star is something that the system is doing well and should not change. They are essential to the viability of the system. Political hot boxes are services that the public wants or which are mandated, but for which there are not adequate resources or competencies. Golden fleeces are services that are done well, but for which there is low demand. They may therefore be perceived to be undesirable uses for limited resources. They are potential targets for cost cutting. Backdraw issues are unappreciated and have low priority for funding. They are obvious candidates for cuts, but if managers perceive them as essential, they should attempt to increase support for them and move them into the political hot box category. Part E. Recommend generic development directions using the ANSOF matrix. ANSOF developed Growth Vector Matrix in 1987, describing how a combination of a firm's activities in current and new markets with existing and new products can lead to growth. Market penetration means increasing market share of existing products via promotions, price reductions, increasing usage, etc. It represents a relatively low-risk strategy since it requires no capital investment. Market development means seeking new customers for existing products, for example exporting or selling via new distribution channels. Risk here is still reasonably low. Product development can be described as selling new products to existing customers, cross-selling. This strategy is riskier than both market penetration and market development, since it is likely to require major investment in the new product development process and, for physical products, in suitable production facilities. Diversification means selling new products to new customers, may offer significant growth potential, but it is risky as it may require significant investment and new competencies. Part F. Assess how internal development, mergers, acquisitions, strategic alliances and franchising can be used as different methods of pursuing a chosen strategic direction. There are multiple methods once management has determined about product and market mix. Next, important decisions must then be made regarding how best to go about achieving these objectives. This brings us on to methods of development. A range of methods is available to organisations, such as internal development, mergers, acquisitions, strategic alliances, and franchising. Internal development, also known as organic growth, is the primary method of growth for many organizations for a number of reasons. Internal development is achieved through the development of internal resources. There are many reasons for pursuing internal development, such as to get understanding of the market and the product, to promote innovation without disrupting other activities with the same style of management and corporate culture and no available target for acquisition. Many problems are also with internal development method, such as long time requirement, barriers to entry, acquire the resources independently, and may be too slow for the dynamics of the market. Mergers involve two separate organizations joining together to form a single entity, whereas an acquisition involves the purchase of one entity by another. The rationale often given by management for acquisitions and mergers is that it provides greater opportunities for business growth than if both entities remained independent of one another. Reasons for mergers and acquisitions are such as entering into new product range or market, buy-in technology, intellectual property and skills, increased production capacity, safeguarding future supplies of raw materials, gaining undervalued assets, diversifying risk, buying a high-quality management team, improving acquired organization operations. Issues with merger and acquisition are such as could be expensive. Customers of the target organization might go to other suppliers. Compatibility issues due to different products, customers, suppliers, markets, employees, and culture. Asymmetric information available to the buyer could be led by the personal goals of the acquiring organization's managers. Acquiring firm may not take non-financial factors into consideration. Corporate financiers and banks have a stake in the acquisitions process as they can charge fees for advice. Strategic alliance is a type of external partnering that involves some form of cooperation between two or more organizations. Strategic alliances often involve the sharing of resources and activities to pursue a given strategy. Strategic alliances range from formal joint ventures or licensing agreements through to looser alliance collaboration. Reasons for entering into strategic alliances such as A. Share development costs of a particular technology. B. The regulatory environment prohibits takeovers. C. Complementary markets or technology. D. Learning exercise for both entities. E. New technology offers many uncertainties and many opportunities. F. The alliance itself can generate innovations. G. The alliance can involve testing the firm's core competence in different conditions, which can suggest ways to improve it. Franchising is a method of expanding the business on less capital than would otherwise be possible, because franchisees not only pay a capital lump sum to the franchisor to enter the franchise, but they also bear some of the running costs of the new outlets or operations. Franchising is commonly used by entities that are keen to achieve rapid growth. For suitable businesses, it is an alternative business strategy for raising extra capital for growth. Franchising is particularly common in the restaurant sector, with McDonald's probably the most well-known fast food franchisor. As is the case with partnering arrangements, it is important to remember that a franchising agreement will be confined to specific operations. This is best illustrated by considering the table below, which outlines the main inputs that the franchisor and franchisee provide under a franchising agreement.